15% in 6 weeks. Not on Wall Street, but on the Singapore Exchange. And they weren't hedge funds, just first-year university students. They made their first purchase on January 26. Just over a month after their first buy, the Iran conflict began. As headlines shifted and tensions rose, some of their stocks moved sharply, both up and down. But instead of reacting to the news, they stayed focused on fundamentals. The team had 45 days. They could only invest in Singapore-listed stocks and not the usual blue chips. Instead, they were given just over 100 small and mid-cap companies to choose from.
I didn't expect us to generate 15.23 returns, 15.23% returns within a 45-day period, because I thought my idea at first was that Singapore markets doesn't move as quickly or volatile, right? Or isn't as volatile as US markets. But I think with this challenge, it really changed my perspective on things.
A 15% return in just 6 weeks is unusual in any market. So what exactly did they do differently? First, they didn't start with companies. They started with trends.
For us, we tried to identify macro trends. So a lot of people will probably focus on the company itself.
They also used AI tools to speed up their research, scanning sectors and narrowing down companies. But it wasn't a shortcut. They still had to verify the data and build conviction themselves. One trend stood out: semiconductors. With AI driving global demand, they expected the entire supply chain to move.
Semiconductors basically did the best out of the lot for all of us. For Singapore's side, we are very specialized or very good in the equipment side of things, so generating the equipment that builds the semiconductors, right? So we'll see that once there's a greater order for semiconductor chips, right, then we tend to see this sector of stocks all go up. So that was really our bet, was to not so much go for individual companies, but target the sectors and target the big players within the sectors.
For property, the edge was closer to home. Not just data, but what they could see on the ground.
I had a strong conviction for the property developers of Singapore. I used my own personal observations around and I tried to make the best out of it. I walk past every 2 weeks or every 3 weeks is changing. It's a new showroom for a new property. So, you wouldn't just do that if things aren't selling well, right?
They even added a gold play, using a local mining company to track global prices. But what really set them apart was how they invested. They didn't trade every day. They didn't chase hype or short-term swings. They picked sectors they believed in and held on.
Makes more sense for us to hold in a short period rather than try to play the news as what many people do. Because I feel like it's just if you have conviction in a stock and generally the fundamentals are there, I think you should just hold it.
Although some days they were down a lot, maybe because of some external news from the US side, we felt that this stock ultimately has great fundamentals and it's a stock that will continue to run. So even on day 15 where it was not performing well, we just continued to hold it.
6 weeks later, they were up 15%, purely from stock price gains. But this isn't just about one team. It reflects a part of the market many investors overlook.
It goes back to this perception that Singapore is a little bit boring, slow, but it's driven by, like I said, the yield stocks, the dividends, which is okay, which there is a place for that in the portfolio. Now, what's important is that we're seeing more and more companies driving growth, driving returns.
For years, Singapore's market has been seen as stable but slow, driven by dividends, not growth. But in recent years, returns have picked up, with earnings growth playing a bigger role.
There are companies that are still waiting to be discovered, but they are actually primarily in the mid-cap space because these are the areas that are a little bit overlooked and under-owned.
Many of these opportunities sit in the same space the students were forced to explore: smaller, less covered companies. But that opportunity came with trade-offs. Less coverage means more uncertainty and more work for investors.
You yourself have to do a lot more primary research, getting your hands very dirty to understand what exactly is this company about. And potentially these names could have slightly higher volatility, right? Versus the large cap names.
There are also practical barriers, especially for younger investors. Unlike US markets, where you can buy small amounts at a time, Singapore stocks are typically traded in fixed lot sizes. But that's starting to change.
If you use the traditional brokers, right, the minimum lot size is 1,000 shares. So if I'm buying a really big company, with a price of, let's say $5 a counter, right, it's basically equivalent to 5,000 Sing, which not a lot of young investors have on hand or have to spare straight away. So I think a really good pivot was when SGX actually came out to say that they're switching for counters that are over $10 from 100 shares being the minimum lot size to about 10. So instead of me needing to put out $5,000, now I can only put out like $500, which is more bite-sized, I feel. It doesn't weigh so much on your bank account or your wallet.
Lower costs and smaller trade sizes are starting to make the market more accessible. For Ryan, the experience changed how he invests.
I first started investing in about 2020. I was very interested in the blue chips because they gave me good returns in the form of dividends. They were mostly very stable and there's quite decent news coverage. But I think with this challenge, basically, I'm now more convinced to go into small to medium cap companies.
What they did wasn't complicated, but it was deliberate. They focused on sectors, not just stocks. They held their positions instead of trading constantly. And they looked where fewer investors were paying attention. Because the takeaway isn't that Singapore stocks aren't suddenly fast-moving. It's that most people are only looking at a small part of the market. For retail investors, the opportunity may be there, but it takes more research, more conviction, and a willingness to look beyond the familiar.
There's a lot of growth opportunities as well, and it's definitely not as slow as people think it is. It's actually quite dynamic, and there's just tons of opportunities, right? You just have to look for it.